There are quite a few factors that motivate us to earn income, including supporting our families, saving for retirement, and even funding our hobbies and activities. You definitely don't want to pay more than your fair share to the CRA on an annual basis. In this video, we're going to discuss how you can reduce taxes on an annual basis. My name is Shian Rashid of SRJ Chartered Accountants. Let's get right into it. The first thing you can do is if you own a corporation, you can choose between salaries and dividends. The benefit of dividends is that you're able to take out $40,000 per shareholder who has no other source of income. And also, you don't have to pay CPP on dividends, which will save you money in the long run. Now let's compare this to taking out a salary from your corporation. If you take out a salary, it's an expense in the corporation, and also you're able to increase your RSP contribution rate. Once you take funds and invest that into your RSP, it reduces your taxable income on the personal level. The second benefit of taking out a salary is that you're able to contribute to CPP. You have to contribute to CPP if you take out a salary for either yourself or any family members. This is a type of forced savings which allows you to have funds later on for retirement. It's important to run the numbers each year to determine which option is best for you. You could save a substantial amount depending on which amount you go with and the number of people you have income split with. The next item I want to talk about are shareholder loans. If you've lent money to the corporation for, let's say, startup expenses, or on an annual basis, if you're paying expenses personally on behalf of the corporation, you're able to take this money out tax-free from the corporation. It may be beneficial for you to take out this money before paying yourself a salary or dividend in any given year. You want to make sure you run the numbers and see what's beneficial for you. Another option you have to reduce income is to loan money to your spouse from your corporation. This will allow your spouse to invest the funds into any investments. The income generated, including capital gains, will be taxed in your spouse's hands, thereby reducing income from the higher earner. Another tool you can use is by loaning funds to your spouse. Your spouse can then take the funds and invest it in stock, bonds, and even real estate. The income and capital gains earned on the investment will be attributed to your spouse and not back to you, thereby moving income from the high earner to the low earner. Another great tax planning strategy for lower income family members is to pay them a salary from the corporation. The salary must be reasonable in terms of the work they're doing. Let's say, for example, that your spouse is completing administrative duties for the corporation and you're paying him or her $200,000 a year. The CRA definitely would not accept that as not justified for the services that are being provided to the corporation. We often get asked by our clients whether they should make donations personally or through their corporation. We recommend to make donations through your corporation as the full amount is deductible for tax purposes as long as you have profits. The last item I'm going to talk about is deducting interest. If you borrow funds to buy shares of a corporation or to invest in your corporation, the interest on that loan can be deducted against any source of income. But you have to make sure you're either receiving dividends or have the option to receive dividends from the corporation for the interest to be deductible. If you want to do a complete analysis to determine if you're paying as little tax as possible, give us a call and we can schedule a personal consultation for you.